And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Anytime you're talking about fundamentals in a market and direction, fundamentals take a little bit of time to play out.
We got crude oil today, kind of trading yesterday's value area really nicely, low to high.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hold that thought.
Yeah. Hello, good people of the internet. It is Coach's Playbook Tuesday, March 22nd. Today, we're talking about not maybe the sexiest of topics, I don't know, unless you are really into the contract role, but it's something you need to know and something that every trader should be familiar with. So we'll talk about how to trade that. But first, Mick, I understand that we have a shout out.
Yeah, this one in particular is pretty special. Shout out to John Manning. It's up $3,100 today. Trading the NASDAQ, but it was actually the micro NASDAQ he was trading. So it's a pretty big number to put up trading micros. So big shout out to him.
No, that's awesome. So futures traders out there, I think it's easy sometimes to forget what a future is, why you trade it. If I'm trading the ES or something like that, I'm just kind of thinking, oh, this is the index, whatever that is. But they are deliverable contracts. The equities are cash settled. It's more straightforward to think of it with oil, where if you were to hold an oil contract, you're eventually on the hook one way or the other for 1,000 barrels of crude oil delivered to the Cushing terminal in, I believe, Oklahoma. You don't want to get to that point. That is why we have the roll enter. Now, we talked about earlier, I think sometimes there's some confusion about, people are always asking us, what is the date of the roll or stuff like that. I think you can think of it more generally as you just want to be trading the contract that is the most liquid. And that means it has, looking at the volume, it's probably the best way to do that. But Dan, what are the rules I think you mentioned as far as the roll?
For sure. First off in Top Step, we kind of have this concept of we want you trading the front month. That's for more than just one reason. We want you trading where the volume is at, where the liquidity is at. It's such a common question I've heard over the years at Top Step. Even before I was at Top Step, we were trading bonds mostly. When you're trading the bonds, it's a quarterly roll. You have to figure out when is expiration, but you're watching the volume because you have to update all your theoreticals and your volatility index based off that product. And so there's a lot of factors that go into what the roll is. And so when you are rolling contracts, or months are rolling from 1 month to the next, whether it's crude oil, which is a monthly thing, equities or treasuries, which is a quarterly thing, you got to have an idea of when that day is. It's not a hard day. A lot of people want to say it's the 17th of the month. Well, no, not necessarily. It's going to be based off of when that volume starts to shift. There's usually a 2-week gap where people are going to start, you're going to start to see volume starting to move into that next month. And that's really where you want to start to pay attention to things. And the key is when you're trading outrights, all you want to do is you want to set the two markets side by side, not yesterday's volume. I know a lot of people like to look and say, hey, CME posted yesterday's volume, that June was more than March, therefore the roll. Well, that means the roll already happened and you just traded a day in the light month. You want to think about that in real time. So what I recommend to anyone, put up a quote board, keep it real simple, put your quote board up and put the 2 different months on there and just look at total traded volume for that day. That's really where you're going to get the best idea of what you're actually trading. Now, at Top Step, one of the things, like I said, that we talk about is we want to make sure you're trading the front month. And we're not going to sit there and go, hey, it rolled yesterday and yesterday you trade the wrong month. No, you got some time. We just don't want you getting to a point where you're coming near expiration, which, like Jack said, once you achieve expiration, a couple things can happen. It's different across the board for everything. But that's where you're going to start to take potentially deliverables on these products. And those are things that you just want to keep in mind. You don't want to be pushing it towards an expiration date because once we expire, you're on the hook for that. If it's an options that you're carrying through expirations, those convert into futures. If it's crude oil, you're taking deliverable. At the end of this, or if you guys want, I think I've told the story before, but I worked with a guy that got a phone call approaching expiration about where he wants his crude oil delivered because he forgot he had crude oil contract on. and almost had to take delivery of it. So those are the things that really what this is about, is just making sure you recognize where that is and just some of the opportunities around that.
And if you're a retail trader, the good news is you don't test this because it's your job as a trader to be on top of these things. You're not going to be allowed probably through your brokerage to carry something physical through the expiration, but it's still not good. You'll find yourself in a super illiquid environment where you might take a big loss getting out of it. I think for retail people, this kind of not futures, but options are a similar way. If you're trading options on stocks, you have to be very careful and know exactly what your position is going to be at expiration. There's things like pin risk. You might just have a big naked position suddenly over the weekend, which these days I would not want to be holding. So just go over the clerical stuff, right? Just like the nuts and bolts of the product you're trading. It's always a good thing to remember. So Mick, you've experienced trading the roll. Maybe I don't believe that our traders can trade calendar spreads, but would you want to talk a little bit about what that is in case people are doing it in other accounts they might have?
Yeah, definitely. So I think what I wanted to go back to is there is no specific date for the roll. The roll happens prior to expiration when traders that have open positions, open interest, they roll their positions from what is, at the current moment, the front month, to that would be next front month. So the roll is done by the traders. The traders and the people who exit their positions or roll their positions over are the ones that determine when the volume in May takes over the volume that was in March, when that volume is greater. So calendar spreads is a tool that people use to roll their positions over instead of just outright selling my March futures contract and going in and buying May. I can trade the difference in between those 2 months, the difference in price, and I can, sell March, buy May, and it automatically puts me into just a May position if I do the same quantity that I'm carrying over. We only want people trading the front month contract, and we consider the front month contract the one that has the most volume because it's the one with the most participation. It's easy to get into positions and out of positions where there's lots of liquidity. It's not so big of a deal if you're trading one contract, but if you have size that you need to do, you have to have somebody else to take that size on the other side. If you're long, you need to be able to sell it to someone. So someone needs to be able to be there to buy it. So that's why we want you trading only the front month contract. Calendar spreads, some people use calendar spreads to roll. Other people, in the past, when I was with a prop firm, we used calendar spreads to make markets, and we would roll positions. So it's basically a tool, but there really isn't much of a need for it here because people aren't holding positions, into expiration and stuff like that.
And if you're day trading, which say you're in the combine or something like that, this shouldn't really affect you because you have to close out a position in the afternoon. So just when you open a new position, just always trade the more liquid future, and you'll be fine on that.
Yeah.
If you are taking longer term trades though and rolling via calendar, let me tell you this. I think I may have talked about this in the show before, but I have been burnt so many times in just ungodly, embarrassing ways, taking large positions and trying to, this is good advice for everyone out there about sticking to what you know, like where your edges and your strategy. Once every quarter at the place where I traded treasuries, everyone suddenly became a calendar spread expert just because it was like there and someone made money off of it once. And so now everyone's doing it. So it would make our P&L monitors look miserable because it was across the whole curve. Suddenly there were all these other futures popping up for like the next month, right? Or next quarter. And B, we'd always get hammered on the roll because it just got worse and worse and worse because of what I can't remember if it was Dan or Mick that mentioned this, right? When you're trying to roll a bunch of size through those, you need someone to take the other side of that trade. And there's less and less interest, for instance, in being involved in that expiring month. So what do we think happens? Well, it's going to get worse and worse price compared to the other one, right? So that is how it can and it does it. It's like Michael Myers in Halloween. It's just such a slow grind disappearing lower and you're just losing money on something. Oh man, I don't even want to think about it. Anyone want to change my mind on that?
So roll
Not at
to
all.
Jack as a scary movie, like a horror flick.
Not at
Oh,
all.
so bad.
One thing I want to touch on, Danny was talking about, how you identify when it's time to roll over. There's a number of different ways you can, for most markets, if you're trading a March contract, as you get closer to March, you should be, everything has a different expiration date. So the roll may happen, which obviously happens before then. Like, know your market. Keep an eye on the quote board, like Dan said. Pull up another dome that shows the volume. If you're trading a certain product, like say I'm a crude oil trader, like I should have a pretty good idea of what the average daily volume is. And if I see that average daily volume seems a little bit lower than usual, or if the quantities on the bids or the offers seem a little bit smaller than usual, that's a pretty good indicator. Like, okay, people are starting to move out of this market. So look at that. So keep up the volume on your dome. Look at gaps in the bids and offers. If you have a tight market like the S&Ps, and then all of a sudden you start to see thinner numbers and maybe a price gap in between the bid offer spread, that's another indicator. Another great thing to do is, I've always loved the CME group. I liked the Board of Trade website when it was the Board of Trade. Now I like the CME group website. Click on a quote board for your product and it shows you all the calendar months listed out, and it gives you, there's one column center right that shows you what the volume is for those products. So, if you're trading off a chart and you're not looking at a dome where they display the volume, take a peek at that every week or so to get an idea of, okay, the volume in this deferred month is starting to overtake what the volume is in the front month. And there you go. It's pretty simple. It's something that a lot of our traders question about. If you're observant of what's going on in the market you're trading, it really isn't something that should blindside you at all.
Yeah, I'll kick this over to JD. I just want to throw one more like almost commandment out, is always second guess or think twice. This is just good in general, and I've seen people do this. All right. Think real hard before you put an order into what looks like a surprisingly illiquid market, right? If the market looks kind of depleted and evaporated, there's a reason for that. And that reason can be you're trading some way off the money, like you're trading the wrong contract. There's about to be a Fed announcement. The world's coming to an end. I mean, like it's just not, very rarely should you be putting orders into a liquid market. And if it looks like that's what you're about to do, think twice. Talk to a friend. Have someone else make sure you are doing what you want to do. JD?
Another simple trick would just to be, I think, find the last trading date for the contract that you're trading. Go to the CME website. All the information you need on that is there. Lots of brokerages put that information out. They'll have a trade desk calendar or something like that. That'll show you when a roll starts, first notice days, last trading days. A roll should be over usually a week before that last trading day. So if you know when that date is, you can get out early enough without having to go through the jumping through hoops. 99% chance your broker's never going to make you take delivery on a product. They'll liquidate the position for you, but they're going to charge you, if they're going to fine you, they'll charge you a fee for doing it. So yeah, know how often the products you're trading are rolling, just like Mick and Dan said. Is it monthly? Is it quarterly? And then look for that last trading date and be in the new front month a week before that last trade date product.
Generally find a trade calendar that you like. We have a Top Step one, but we use it in conjunction with the Ninja Trader one's pretty good, the Ninja Trade Desk. But there's all sorts of resources out there. And just make sure you got what you need in your calendar. Big numbers, rolls, Fed announcements, things like that. Definitely be ready for them. So that's all I have to say as far as the roll. Dan, what do you got?
Yeah, I just want to add one thing that, something to keep in mind when roll is coming, that's not really a day trading paradise. The people that are really focused on big time spreads and moving from contract month to contract month, they're not looking to make money on them. They probably, like Jack said, they kind of expect P&Ls are going to take a hit because their job is to take these positions and move them into the next month. it's a large deal for firms when they are rolling positions, even if it's rolling 15, 20, 30, 100 contracts, which some of these firms are way, way bigger. I think my biggest roll, I think we did about 250 bonds from one month to the next. And that was like 3 or 4 solid days of work. We're not looking to make money. We're kind of accepting that there's going to be slight losses potentially in that. We're not concerned about the direction of the market. It's strictly, we need to move our position from the current month we're in to the next front month that's coming. And that's the focus. It's not about direction. So as an outright day trader, don't hesitate to use that as a chance to get time away, to step away, to go and do something for yourself. Like, yeah, it's not ideal trading conditions.
It's like a tax you pay for a liquidity premium, right? Everyone wants to be in the most active contract, the most liquid contract, and you end up paying market makers essentially for that ability. And it usually ends up being, a quarter tick or whatever else. The bottom line is, unless you're trading big spreads or butterfly positions, you're never going to have enough contracts on that it matters. Just get into the next one. If you give a tick, so be it. That's, not a lot of money in the long scheme of things. You'll be fine. Now, where it could go bad is if you start playing around with all sorts of cute stuff. No, just do it. If you're trading outrights, just suck it up, move to the next contract would be my advice.
Absolutely.
All right. Well, Dan, do you have a quote for us before we get out of here today?
I do. It kind of goes off my last topic here. It's from Jesse Livermore. Every once in a while, you must go to cash, take a break, take a vacation. Don't try to play the market all the time. It can't be done. Too tough on the emotions. And I would completely agree. And I think roll is a great chance to step away for a week, go focus on something else, go enjoy your time.
Nice quote there, Dan. That's all for us this week. Hoag's hanging out in the Ozarks right now, I think. So he'll be back next week as well. But in the meantime, check out the podcast at 3 p.m. on the YouTube page, forecast and recap. JD, you're doing that this week, right?
This week, yep.
Well, come and see Mr. Doherty. Throw it down. All right. Have a great week, everyone. We'll see you soon.